Ilan, how you doing, man?
I am good, my friend. How are you?
Doing good. We got the connection through one of your writers, Karen Fistman, who has created some really killer content for you guys. And chatting with her, and then I saw you all over my LinkedIn, and I love your style, and I think this is going to be a fun episode. So, for the listeners that are not familiar with yourself or FirePower Capital, kind of give, like, you told me the story about how you had started in this business of being an entrepreneur and what you're providing. So give us kind of the couple highlights and the cliff notes from where you were and then how you ended up creating FirePower.
Yeah, sure. I mean, complete fucking accident. I mean, I started my career. Well, even just go even further back. My whole life wanted to be a doctor. Did my degree in genetics, went to medical school, and then had the only Jewish parents on the planet that said, "Don't go to medical school," because they knew my DNA more than I did. So I ended up doing my MBA. Got recruited by a venture capital firm. Said no to medical school, and then 2 years into kind of my venture capital career, realized that I was basically unemployable because I absolutely fucking hate doing what people tell me to do. If you don't sleep in my bed, you don't tell me what to do. It's real simple.
So we know who the true boss is. Right?
Oh yeah, no, the wife is the true boss. There's no question about that. And speaking of the wife, being a huge backbone and part of it, because being together with my wife since I was 18. I have 2 kids together now, so I think that crazy entrepreneurs typically have to have something in their life that is solid and stable. Because when many things aren't solid and stable as an entrepreneur, typically you need something, and that's definitely been my wife. So landed up 2009, leaving venture capital to start FirePower with literally a desk, a chair, and a phone. Partnered with a high net worth individual to help him diversify his portfolio through kind of a family office offering. Doing a deal a year became increasingly challenging for someone of my ADD level, which is super fucking high. And, so landed up starting our advisory practice. So we're now one of the largest kind of independent mid-market M&A shops in Canada, a group of about 40 people, and have been a professional opportunist kind of ever since. I own everything from the largest axe throwing company in the world called Battle to a home healthcare business to, within FirePower, we buy businesses through our private equity division, and we lend money to companies through our private capital division. So pretty well diversified at this point. Have an incredibly good group of executives around me that make me look like I'm not a complete idiot.
That's the whole goal, right? Leverage.
Exactly.
So, what I absolutely super enjoyed about when we first started chatting, and coming from my background of some of the different capital issues that we had when I was running the family business, and then you and I started talking, which we'll get into, about the challenges of the financing of transactions and growth and all these different things that I think you have really started to wrap your guys' head. I mean, I haven't seen anybody, honestly, that has kind of got the full suite of services that you guys do, and I love how you put it. And maybe you can kind of, I don't want to spill the beans, but like how you said, like, if you're an entrepreneur, and you and I were talking about some advice and the challenges of all this stuff, but like, how did you come up with all these different ways to help entrepreneurs? And what is your goal when you're sitting across from someone? I mean,
my utopia when I looked at it and down the road was always to create an ecosystem. I'm a massive believer in ecosystems. And that's about, it can go from your network to, your advisors. It means everything that you surround yourself. You're only as good as the people around you. So for us, it happened quite organically. I was a venture capitalist, and I saw how hard it was for these earlier stage entrepreneurs to raise capital, how inefficient the marketplace was. And it was about who you know, really not what you know, for the most part. So, having a hack for that. And what was even more interesting is, some of the best entrepreneurs were engineers who were naturally really bad at speaking to people and, being promotional. So sometimes the people who got the money were just the loudmouth, obnoxious ones. I should fucking talk.
Self-awareness, right?
Yeah, we'll get to that later. And then it was good companies that how do they take the next step? So it was when we came up with our debt offering, it really was to provide entrepreneurs, in lieu of a Series A, the ability to kind of scale their businesses. And then when I thought about it more, I'm like, well, you know what? Like, why aren't we helping some of these companies monetize their businesses through selling them? And that's kind of how the advisory practice works. Or on top of that, buy some of them, right? If we've worked with some people that we know are great, why aren't we buying some of them? And why aren't we buying some of these businesses that we think we can help scale and get in deep, maintain some of the equity with the existing founders and really help them take it to the next level. So I don't know if I answered your question.
No, I think you did, because what I found is so interesting is we're going to kind of, I know we're going to touch on kind of the private growth capital that you guys are kind of pioneering, and then like how this whole ecosystem works. Honestly, that was the challenge that I had when we had our business. Like, so we were on this horrible financing structure called factoring, which you are probably familiar with. And like, you just and banks really don't want to lend people money. And like all this, like the capital.
No, they do if you don't need it.
Right. I was talking to some, I made a call on a bunch of bankers recently because I'm looking at buying a couple partners looking at buying a business, and like, oh yeah, we'll give you a loan, but we need 100% collateral. I'm like, what's the point of the loan? I don't understand. So there's this whole of financing cash flow and how like constricting the capital markets are. So I think it's just really interesting. Going back to, I think you did answer, because an entrepreneur, to accomplish your goals and to grow your cash flow, I mean, like, capital is the hardest part. And I don't think when you say the markets are inefficient, I mean, there are, and maybe kind of give give some of your 2 cents. And when you say it's inefficient on like finance, what are some of the things that you see and how you're helping them? Maybe that kind of goes into the private growth capital, because I think huge problems out there.
Yeah. I mean, you're better off to have no revenue than have some revenue, because at least with no revenue, no one could tell you your forecasts are wrong. I use this word a lot, the valley of death. I speak to a lot of VCs, and I've been in that community for quite some time. And if you're not growing your revenues by, multiples every year, there's no interest anymore. It doesn't matter how much you burn. I mean, literally look at all the success stories.
I know,
and the amount of money they burn through. It's about growth rates, and it's about maintaining the growth rate so that then you can then sell it to the next schmuck in line, or that same 10 times forward 12-month revenue. I mean, the fact that I can even say 10 times forward revenue is fucking insane.
It's so stupid. I know.
But that's the reality of what that market looks like. Yet there's some really good, stable businesses that have maybe raised a little bit of friends and family money, or maybe grown organically, and they're doing 100, 200, 300 grand of revenue a month, but they're growing it at 100% a year. Ugh. How horrible of them, huh? I mean, that's disgusting. Yeah. And yet, no one's interested, because they've proven that that's the business model. But there's some phenomenal businesses. And last time I checked, there were a lot of people that made a lot of money by growing real, scalable, sustainable, good businesses that actually make fucking money.
Right. So, which is interesting, like, so maybe this can, because I do want to touch on kind of you and I, make sure that we go back to like the market, what we see happening as far, because like you know, when we were talking last time, you had some really good, I think, insights on some of the variables that are going to be kind of impacting us, and like the wave and the different kind of economic factors. But, before we do that, touching on this private growth capital, I mean, I read your guys' article and I was just like, holy shit, that makes so much sense. Because, I found, like, as I've been talking to these, to a lot of these banks, I mean, and for my clients, whatever, I'm not trying to generalize too much here, but understanding actual cash flow and operations versus saying, hey, you have equipment and land and buildings.
Totally.
And like, so maybe kind of tie that together on how you're looking at the financing and how you see this new kind of market coming up of private growth capital that is not going in and saying, hey, I'm buying 100% of your company, but like fueling what they're actually already doing.
Yeah. So, I mean, the market in Canada is even more exaggerated than the US market as it relates to this. So I'll speak about it from a Canadian perspective, but it relates North America wide. The banks understand balance sheets. Right. Mm-hmm. I mean, they understand AR. They understand. I mean, you spoke about factoring earlier, which is exactly that. It's just margining against your receivables. Mm-hmm. They understand inventory. They understand equipment. but they sure as hell don't understand the income statement. I mean, outside of a covenant that is a debt to EBITDA ratio or something like that. Even debt to equity. I find debt to equity hilarious because I say, well, why does 3-to-1 debt to equity matter for a SaaS-based business that pummeled money into building this thing, but now is cash flow positive? And their answer to me is, oh, well, they're over trading on equity. I'm like, I don't know what the fuck that means, which means you don't know what the fuck that means. That is that's just a word you heard from credit at some point in time. So it's the patterns of behavior. But that being said, let me be very careful to say this. I get why that exists. When you're a bank with hundreds of thousands of employees, and you're as big as some of these banks are, you cannot afford to not underwrite through boxes. You're just too big. So that's why I'm okay with it. I get it, but it is a responsibility of the other parts of the market to feed, fill the market with what it needs. So how we've really built our product is that we're focused on enterprise value, and enterprise value means a lot of things. We sell companies for a living. So I think our idea, our viewpoint on EV is usually based on fact, because we're not just going to go and say, 10 times forward revenue, because that's insane and not scalable. But we also understand that there's a lot of companies that choose to break even or burn a little money, especially if you're building a recurring revenue stream, where it's like, well, should you really penalize these guys for investing in a sales team and a marketing team when they have $4 million of recurring revenue at 80% margins that they could just milk for the rest of their lives? But they're trying to grow. Like, why can't you? Like, you got to look at that situation, with a lens to actually try and understand it. And don't just look at the numbers as being the numbers. And this is this is what the cash flow spits out, because it's not true. I mean, people talk about normalized EBITDA a lot as it relates to selling companies. Well, I talk about normalized cash flow a lot as it relates to lending to companies.
Mm-hmm. I think that's huge, because like I do agree with what you said about the banking system, because like they need to get their money back. And right, when you have that many people that you're lending to, I mean, there's only so many things you can do. And Ilan, have you read the book Capitalism Without Capital?
No, I haven't.
Oh, dude, it's an amazing book. So Bill Gates actually wrote a big, huge blog article on it, and there was like 30,000 comments on it. And you totally you totally rally around it. I mean, essentially the gist of it is that the banking financing system of the entire economy is totally faulty, because we can't bank on assets anymore. So it's capitalism without capital. Like there is no tangible stuff anymore. So you have to be looking at cash flow. Essentially and that's the whole premise of the book, is that, which is funny because I read the book before I came across you guys, and you guys are like literally popping up, fulfilling what the book is saying, is like the new financing mechanisms need to pop out there, because how else are like people supposed to grow and invest, right? I mean, because otherwise you're constantly like measuring the wrong things.
I mean, take it even. Let's talk about an actual stat. I heard that there's as much as 10 times the amount of gold traded that exists on the planet. So going back to your point, I mean, I don't understand these derivatives of derivatives. I just truly don't understand it. I mean, I'm in finance, and I can't imagine that these retail investors understand what the hell they're buying anymore. But like, I'm a big believer in just real business. Like, if you can't show me, Uber, how you're eventually gonna make money, and they talk about unit economics or country economics. Even a funnier one. I mean, you must have seen what the WeWork CEO came out and said about community normalized EBITDA. Like, what the fuck does that mean? Like, that is like, now we're making up terms to rationalize burning money. Like, it's
right.
insane.
Like, and I look at, like, you say real businesses, like, so you come to a location of yours and you throw axes. I give you money, you give me axes, and the exchange is done. And at the end of the day, you net more than you spent.
That reminds me of a Mitch Hedberg routine.
I love Mitch. Oh yeah.
So one of my favorite Mitch Hedberg jokes is, I come to a donut store. I give you the money, you give me the donut. We don't need a receipt.
When will I ever need the proof that I ate that donut?
File it under D for donut. Um, but yeah, I mean, why does life have to be so complicated? It's providing services, you know, and products.
Well, and that's what I love is like in the value is associated. Like there's a guy that I have grown to absolutely love. His name is Ken Sangenario. He did this. He built a product called the Value Opportunity Profile, which takes the build-up method of evaluation and actually identifies the company specific risk. So he's got all these questionnaires, so it ties the company specific risk into the discounted cash flow. So it's like actually identifying the risk. And he was just talking about how it just doesn't, like, that's the true essence of a business. And like when I went through the certification, Elon, I was like, holy shit, they like none of these valuation consultants identify company specific risk.
Yeah, because it's just about cash flow. Because apparently, you know, traditional phone system cash flow is the same as VoIP cash flow. No, it's not. like when did common sense not get layered into valuation metrics?
Right. So, you know, when you and I were talking about, like, you know, as you know, you had said, and this is kind of the whole point of the podcast too, is like when you sit in front of an entrepreneur who runs a company, you want to be able to help them any way that they possibly can. Right. So no matter what meets their needs. But as you start to look at all the things that you're seeing, and you and I were talking about some of the macro stuff that's happening, because we were talking about private equity and, you know, where these people are raising the money from, and like just some of the big things that you're seeing and that you're tracking. If you want to kind of give us like a broad brush stroke of, like, you talked about some of the PE money that's kind of being, you know, recognized now, and with how the multiples are and the actual rate of return are happening. And then, like, you and I were talking about the baby boomers. Just kind of give.
Yeah, so I'll give you my pitch, and I'll start by saying I'm inherently biased because I make money by selling companies. So obviously, you know, I have a vested interest in convincing companies to sell their businesses. That being said, I'm 35 years old. I look at this game long term, and I really try and remove as much of my personal bias out of it. So I'm hoping that this comes across authentic and not as a sales pitch. But this is the reality. $5.7 trillion have been raised by private equity since 2015. I think $3 trillion is sitting on the sidelines. Or is it? Yes. There's
between
more,
2 and 3.
There's more trillions sitting on the sidelines than has been called since 2015. So you have this gluttonous supply of cash. Okay. You have interest rates at historical lows and availability of leverage at historical highs. The amount of multiples that banks are now giving to sponsors to help them compete in these inflated times of valuations is astronomical. So what you land up and then on top of that, you have baby boomers that, for whatever reason, I mean, I've been calling it for 10 years and I've been wrong for 10 years. At some point, I'll be right.
Well, they're just going to get old. Like, they're getting old.
They're going to die. At some point, they have to be right. Like, maybe they hold on until they fucking die. I don't know. But the reality is the supply of good companies is limited. So you have, like, I hope you could tell from the way I talk, like, I really believe in simplicity. But if I can't explain this to my 7-year-old, then something is wrong.
Right.
It's simple supply and demand, right? You have a low supply of good businesses with good cash flows and a fuck ton of demand for these businesses. So that's what's led to these historically high valuations. And I speak to an entrepreneur who says, well, I could take my business from 4 million EBITDA to 8 million EBITDA in the next 5 years. I said, that's fantastic. You might be worth the exact same amount. Because today, today someone's willing to pay you 10 times. But I think people forget how quickly things turn. Mm-hmm. You know, like, go back to 2008, go back to the early 2000s. When shit turns, it turns real, real quick. And what I tell these entrepreneurs is the supply is coming. Right now, it's a seller's market. The supply is coming. And these private equity firms are going to have a field day when that supply comes. And, the whole market dynamics reverses, which it will. It absolutely will. It's just a matter of time. So, I mean, that's what I think is going to happen. And I think it's going to happen really, really, really quickly.
So let's peel back because I'm agreeing with you, man. And it's funny because you and I are close to the same age, and I look at when I kind of hit into the actual working world. I mean, the economy had taken a shit, right? So I'm used to waiting for the hammer to drop and working in the hardest times, and then you start to realize so when we sold our business, which was 5 years ago. So the average age of those 6 million, so there's 6 million privately held companies, right? You and I were kind of going over these stats, and I do it a lot on the show, but 6 million privately held companies, only 20,000 of them are over 100 million, and they employ 30 million Americans. So then there's between 5 million and 100 million in revenue. There's 350,000 companies with 35 million Americans working for them. And then there's 5.6 million companies underneath 5 million. And if you just take the numbers that you and I know of the cash flow, you say, okay, you're doing 100, or if you're doing 10 million in revenue, you're probably doing $1 million in EBITDA, something around there. Well, you're essentially getting retail help of all your advisors. You do not have bank financing that'll help with the transactions. You're screwed. I mean, to try and hand this off to someone, because private equity doesn't go down below 2-3 million in EBITDA. And so therefore you have 85% of companies that are underneath the elite help that's out there. And the average age is now 62. So when we sold, they were only 57. So 57, you're feeling good. You got energy. Now 62, you're going, I got now Social Security. I'm now a grandpa. I got friends that are getting health issues. And the tide just changes. And so kind of given that context, Ilan, kind of give your 2 cents on so the money that's sitting there and that's been deployed through, because PE firms are popping up left and right because they're raising because that money needs to be deployed. But it's not the money that's going to be solving the problem that I just discussed. So and then they're now realizing the rate of return. So kind of explain what you were saying about how how the PE market's going to shift.
Yeah, I think they're going to be forced to actually get their hands dirty. They've had to. They've had the luxury, I guess, of buying these bigger businesses, which there's not many left. Those businesses are real enterprises, right? They typically are. They get higher multiples because they are more stable. That, there is a function of that,
right?
These smaller businesses, it's run by Joe and Mary and Sarah. You need to figure out a way to get on the shop floor and transition those relationships and learn those businesses. It's going to benefit the operator more than the financial engineer going forward. And it's exactly, people thought that I was crazy. Our head of private equity is an operator.
Mm-hmm.
He's an operator. So he is absolutely not a financial guy. He brought StubHub to Canada and was one of the executives that was responsible for that. He was brought on by a private equity firm to a fintech company to be their chief strategy officer. And everyone's like, why would you put someone like that as the head of your private equity division? And I said, because it's exactly that. When we buy businesses, we're going to have to go in there and get our hands dirty.
Mm-hmm.
And what we're starting to do is build an operational support team, at head office that could be loaned to these companies as we buy them to help, institutionalize them. Mm-hmm. That can help, transition the DNA of some of these smaller companies into, what is a more sustainably, managed business that isn't reliant on one individual. But I think a lot of private equity firms are going to make the mistake of just going down market and putting a whole bunch of these businesses together and get their fucking asses handed to them when it all falls apart.
Well, because I've been watching that too, and I'm sitting there going, okay, so as I've because I went the different way to where I am today too, where I was running a business, right, and helped turn around a business, and then you're working in that lower mid market, and then as I started learning about the financial engineering and all the deal structure, I'm like, people can just shuffle shit around. And so the reason you hover over 2 or 3 million EBITDA is because you can literally fly across the US, sit in on a boardroom, go, you should be doing this. And then you fly back home. I'm like, well, what happens when you have to rip apart the ERP system or fire the VP of sales because they've got personal issues? I mean, the real stuff, right? They don't know how to do that. And they've been there's this whole secret sauce over the years that, it started with Blackstone, and then they just moved all the way down where they were just capitalizing this cash flow that a lot of people just didn't understand.
Yeah.
And then the average rate of return was, kind of go back to tying that back to the dry powder and the capital that's sitting on the sidelines. And what you mentioned in the last call with me is what's happening is the rate of returns that these people's promised, like the institutions that they got it from, and what you see actually happening and how that's going to impact going forward.
Yeah, I talked about the supply of good companies. The supply of companies, period, is going to go up. They're not going to achieve the returns that they've promised. The days of mid-20 returns for private equity are over. You cannot buy something for 17 times EBITDA and expect that. It ain't going to happen. So what's inevitably going to happen, and quite frankly, the private equity teams know this. I mean, behind closed doors, no one's talking about 20% returns. Like no one. They're talking about how the hell do we maintain 12, 13, which is a radical shift. So what's going to end up happening is the institutions are going to start, or the pension funds are going to start moving more of their money into fixed income. I mean, it always just shifts back and forward and back and forward. So you're going to have this double compounding factor of the private equity firms raising less capital when those returns start to play out, right? Mm-hmm. They're still protected by the fact that a lot of these funds have vintage years still left in them. Like they raised 5-6 years ago, probably bought a few companies well. Those funds don't look too bad. But the funds that they're raising now, I'll put a bet. I'll put a bet that if you can go back 6 years from now and look at the returns from 2019 raised funds that were raised in 2019, I'm willing to bet on average sub 15%. And I think I'm being extremely generous.
Well, because I think when you like smash some of those data points together, you're saying, okay, well, they were able to raise the money from people, the institutions, so pension funds and endowments and all these people that need. And I actually look at one more like variable after that, Ilan, is like these pension funds and stuff are going to this kind of asset class because they have too many liabilities from the people that are like, that they have to pay for the retirements, while the whole wave of baby boomers are like actually going to the whole thing just doesn't make a whole lot of sense, like how it's going to work out. But then, so like when you say that like those rate of returns, so those institutions needed that 20%, yep. They pay their liabilities. And then, when you say that when you look at those numbers that I was talking about of like the 20,000 companies that are over 100 million in revenue, and then like they don't have the ability to actually talk and actually invest in work in the companies that you and I are talking about. Cause like there's going to be that wave that comes, but I don't know who has the financial wherewithal and the operational experience to be able to like actually be buyers of these companies that are going to be going for sale.
I mean, no one yet. I mean, people talk about the search funders. I mean, I know the search funders are a big part of the kind of the American story. Look, some of them will end up being great operators. Some of them won't be. I mean, they're all fresh out of Ivy League schools. I mean, I don't know how many of them really know what the fuck they're in for, right? Like you just like you go to networking events and you wear your fancy tie, and you're going to be going and meeting Joe on the front lines of a manufacturing facility, and he doesn't give a fuck about your tie. He cares about the machine not being broken, right? Like that, I don't know how these people are going to relate to some of these individuals. Like they're in for a world of hurt. And I've always been fascinated by the reason that these search funders have popped up, because I don't know what makes these Ivy Leaguers good at operations. I mean, I'd argue that they'd be the last ones I'd back in that capacity. I mean, show me someone who dropped out of school in grade 12 and somehow made it work. Like I'll back that person. Like I think it's actually counterintuitive.
Yeah.
But maybe a lot of these guys that invest in these search funders are actually buying themselves mentorees. Like there's something that they're getting out of it emotionally.
I was gonna say I think there might be a little bit of that, and like. And there again, just because of the people that you and I end up talking to, like I have probably a skewed version of it where like there are people out there that have, had a track record of, not necessarily track record, that's a bad word, because that's more financial perspective of like, 10, 15 years in the working world. And they're going, but that's like the 1%, right? They're going, okay, you're capable of doing this.
There's good in every, like there's some search funders in Canada that have done a phenomenal job. But like, I wouldn't have known how to pick that you were that were going to be that. Like, it turns out they're awesome.
Yep.
Right? There's always going to be awesome operators and not awesome operators, and you're not always going to know. But yeah, it's
but then you say, okay, well, there's gonna be 3 to 4 million companies that go to market in the next 4 or 5
yeah.
to 7 years. Like, how did
I think a lot of them are just going to die. I think they're just going to just literally die. The other thing that I think that banks and other lenders are going to have to do is we're going to have to get a lot more aggressive in helping a lot of these managers actually buy out the businesses, because they're the most equipped, right? It's going to come from internal. The problem's not going to be fixed externally. Maybe we buy 10% of the businesses as competent private equity buyers, but companies that are sub 500K in EBITDA, I don't think anyone could really buy. It's really difficult because it's usually reliant on the relationship, and the only person that's probably best suited to take over that relationship is someone internally.
Well, and even if you could, you can't cash flow with the banking mechanisms that are out there right now, right?
It's going to require an owner that helps their management team buy the business by kind of being a sub debt within the business, i.e. the VTB, and then more creative banks that aren't looking for astronomical returns that are going to bleed the company out of the much needed cash flow. But and guess what? Sometimes there aren't solutions.
Yeah.
Sometimes there aren't.
Yeah, it's interesting, man. I think about those dynamics, and then you slap on Ray Dalio's whole opinion about our big debt cycle and the technology innovations. I don't know. It is interesting time because you and I that's why I get so jived with our call, because I'm I totally get this stuff and it's so apparent, but then it's everybody is on this heyday of paying 10 times revenue or EBITDA for these companies. I'm going, I don't get it, man.
They don't have an option. They have capital that is committed to them, and the only way they make money is by deploying capital. So let me ask you: if you put out 20 bids in a row and you lose every single one of them, what are you going to do as a team of 8 guys in a room
that are supposed to spend money?
You're going to increase your price. You don't have an option, whether it's clever or not. I feel bad for them. I really do. What are they supposed to do?
Yeah.
What are they supposed to do? If they keep losing and they've committed to people that they're going to deploy capital, there's nothing they can do.
Do you think, Ilan, that there's when I was as I've been talking to some of my closest partners and mentors and stuff like that, is there's an opportunity for wealthy individuals and family offices who don't have to play the games of the institutions to create. I don't want to say a private equity fund, but a slush fund, whether it's the private growth capital that you're talking about, or ways to help finance the transitions of these, the 250 to 2 million in EBITDA, which I think is the heart of America. There's got to be some ways to rally some people around that have different perspectives and literally can call the shots with their own money instead of up the chain of suits. There's got to be some.
They are doing that. I'm starting to see that trend in Canada, at least. And quite frankly, they're better suited for the problem because a lot of them made money in businesses that they grew. So they are entrepreneurs and operators by just DNA. Have they transitioned that skill set down to the second or third generation? Your guess is as good as mine. I don't need to rhyme off the stats of third and fourth generation money. I think everyone knows what those look like. But some have. I know some very, very great family offices in Canada that have some phenomenal first generation and second generation talent working together, really branding themselves as a private equity business looking to get more actively involved. So it is starting to happen, and people, we're not the only two that see the writing on the wall. People are starting to take notice. Probably not as many as is needed, but so be it. That's the opportunity for people like us.
I agree with that.
Yeah. There'll be people listening to this podcast saying these guys are absolute fucking idiots. Okay. Fine, we're idiots. What are you doing?
Yeah, right. Well, I appreciate it. It's just so nice to not know that I'm the only crazy one. So at least you and I can be by ourselves, even if we are wrong. But what do you experience with I think the sentiment's changing a little bit as I said, as in it's so funny because I don't know how many people you talk to on a daily basis. I talk to a lot, right? And like you start to hear the chatter change, and like when you have like, even my dad's, cohort of his age bracket. I mean, they're not talking about growing business anymore. They're going, how the fuck can we get down to Fort Myers? You know what I mean? Like, how can we get out of this? And so like you start to hear the chatter change a little bit, which starts to kind of like, are you seeing anybody that's actually doing preparatory work to get their businesses like prepped and ready? Because that's the whole point of my business and the podcast. But like, I find it difficult to find the people that want to do the hard work to get the actual outcome that they want. And then also it's like, because the mental shift, it's hard to come back from that. You know what I mean? Like to go.
Yeah, no, totally. I think again, it's I might have an overinflated view of how many people are doing it because I speak at so many events on this topic. So I'm meeting the business owners that are taking the initiative to come to these events.
Yeah.
So I see a lot of people that are looking to get information on how to get ready, but I'm sure for the 50 people in the room, there's 5,000 that aren't there.
Yeah.
But I'm not.
Well, then the 50 in the room, how many people are actually going to do it too, right? So you start to like.
Yeah. No, it's a good point. It's a good point, and I do agree with you. The emotional side of it is hard to come back from. Like once you've kind of committed to that process, you got to go. I mean, we're investing pretty heavily internally. We just hired a full-time data scientist to come on board, and we don't even have a plan for him. But what we want to do is we want to rent this individual to some of these companies who have swaths of data to figure out what they're doing right and wrong, and B, ways of monetizing their data as an additional revenue stream within their businesses to enhance their EBITDA prior to sale. So we got an Israeli data scientist, as one does. I mean, as one does.
You working on the Snuxnet virus back in the day.
Yeah, and then we're looking forward to it. We're looking forward to seeing how we can help facilitate that transition. But yeah, the issue is you can't force entrepreneurs to do things they don't want to do.
They're 30 years into they're 30 years into not taking orders from anybody.
Yeah, exactly.
Well, it is interesting because and that's why I think what I've been trying to facilitate with our business and like even with the conversations and the conferences and the keynotes and all that stuff is getting people into that's why I think the private growth capital is a very genius way of getting into the relationship before the exhaustion happens, because once that happens, like people don't want to do the hard work that it takes to actually continue it. And so there's got to be ways to insert into like the momentum of the energy before that like shift in the mindset happens.
Yeah. And sometimes you get it right and sometimes you get it wrong. I mean, just an interesting story of how much effort, you need to play that game. Our first loan we ever did for $1 million went bad. We had to put the company through a process. We landed up doing a creditor bid, bought the business with our own debt, basically, moved them from their location into my office, took them down from 27 employees to 7 employees, rejigged their entire business model, brought in a CEO, but then 14 months later, sold it for 6.5 times.
Holy
right?
Shit.
So incredible outcome. But like that's just
a whole lot of work.
That's just pure and utter like brute force, right? You have to be willing to do that, and not only that, you have to be willing to do it at scale because there's no question. I mean, that sounds like an incredible outcome, but I promise you that the amount of money we deployed in the fund was vastly reduced because of all the time and attention that went into that kind of turnaround. Mm-hmm. So there's an action for every, a reaction for every action, action for every reaction. So, nothing's smooth. It's about, how you deal with it. I do think good strategy isn't enough. I think good strategy layered onto like really fucking hard work. And a lot of people just aren't willing to put the work in, as you say. They get tired. You got to be honest with yourself and know whether, people say like, oh, should I go buy a business? I'm like, do you want to put in a lot of work You know, and not like not say that you want to, but do you really want to?
Oh my God, man. Like, it's so funny because like when I tell people, I'm like, yeah, we were juggling $250,000 payroll every 2 weeks. And like there was like 25 times that didn't have enough money. We always made it, but like we always joked that my dad and I joked that like the price of Captain Morgan went up while we were doing because it's like you just can't give up. You just don't like what are the options, right? And that, but I said like there will not be anything that I do in the rest of my life that is harder than that, like ever.
Brutal. It really is. I mean, yeah, it's
So if you were a listener so one of the 50 people in the conferences that you're given like the speaking events all the time, or you're one of the listeners, like what are like actionable things that you tell people, like do these things, think this way, and like that you'll actually see results? Like what's kind of your usual?
Well, as it relates to preparing for a sale, is that kind of
whether it's for sale or growing the business or like navigating the waters of what's to come in the kind of whatever usually rolls up.
Yeah, I'd say, I mean, this is a universal thing I always say is people don't invest and they don't buy individuals. They invest and they buy entities. An entity means it is something unto itself. That is the definition of an entity. Mm-hmm. So if your business is reliant on you and you don't have the infrastructure below you to support, scale, and if you got hit by a bus, this thing would die. Figure out ways where that's not the case. Mm-hmm. And I know it's hard for some people because there is a bit of an ego trip with being the man or the woman, the one that everyone goes to. But I can tell you, it's a lot more fun being able to build a real business. Mm-hmm. And building a real business relies on not everything funneling through you. Mm-hmm. So that's one of the things I would absolutely tell people to do. I would also tell people to take their head out of the sand and don't make excuses for loss. I cannot stand people who lose a deal or lose a client and then somehow rationalize it to themselves by saying, oh, well, we didn't really need that client. Like that's a recipe for disaster. And I've seen it over and over again. If that doesn't burn you and cause you to reflect on what you did wrong, you're fucked. So be self-aware, let things hurt, consistently evaluate what you're doing so you don't be the one that's, dead in the water.
Mm-hmm. If you were, there was one of that's super good insight. And I was thinking about one of the videos that I saw on LinkedIn of you, and you were talking about like, so if you're an owner and you're thinking about either selling or staying in, if you were to forecast over the 10 years, how would you make your decision? So would you be the one that is buying up these other businesses and staying in for how long? Or like if you were planning on selling in certain, range, what would you do? Like does that question make sense?
I would sell now or in the next 2 years, or I would sell in 15 years. I think there's going to be some carnage, between 5 and 15 based on all the things that we've spoken about. I do think it'll be a great time to buy between 5 and 15. So it will change, like I said, from a seller's market to a buyer's market. But if you're looking at selling in 8 years, I would caution you greatly about selling in 8 years.
I don't know if there was a guy, an economist that it's ITR economics that, so the listeners want to go back and listen to it. He was talking about the 10-year forecast. This guy and his company, they advise to Vistage worldwide. I don't know if you're familiar with this Vistage up in Canada, but it's peer groups, right? So 25,000 business owners. And so this guy, he goes, if you want to grow and sell your company and do that, he goes, what I would do is I would grow my company up over the next 2 or 3 years, and then I would sell it to the person I hate the most.
And then buy it back when it's fun.
Yeah, and then buy it back for pennies on the dollar 8 years later. Yeah, for
sure. It's going to be interesting. I mean, at the end of the day, what's beautiful about it is we're all guessing.
Right.
You can have as much conviction in your in your thoughts as anyone else, but the beautiful part is we're gonna find out because time goes one way.
Yeah, that's very well said. Well, if the listeners want to get in touch with you, want to follow you, or what all the resources, what's the best place?
Yeah, I mean, look, I'm pretty active on LinkedIn, as you know, Ryan. So hit me up on LinkedIn, and you can contact me by email anytime. I'm pretty damn responsive. So happy for you to give them my email address.
Ilan, this has been a blast, man. I appreciate you coming on the show.
Yeah, thanks very much.